Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Russell 2000 index. That's ticker symbol RUT. And if you are a new follower of the market guys, you should know that I leave my lines on the chart each and every week so you can see how the forecast is worked out. And this also helps build your confidence in the technical signals because we do use candle charts quite often. Once in a while, we will use a line chart, but that's rarely. It's usually on the intraday charts. But as you can see, the lines that I drew last week are still in place. I said that for the Russell 2000, we would most likely pull back and then start to rally towards the end of the week. Now, we did pull back Monday, especially. We had a big down day here, and we had Tuesday, we had a Harami. Wednesday, we had a doji, big green candle on Thursday, and today we have a red candle. And the reason I'm pointing your attention to this candle is because we did not have a higher high. Now, I do think we will ultimately hit our price target. You'll see the end of that line is right there. It ends on August 19th, so this is a 2-week forecast. But I'm going to adjust this in two ways. I'm actually going to remove this because we did break down below that support level. And now this level becomes our new support line to keep an eye on. If you're wondering how to manage risk, then understand that we draw flat lines right here to identify support. So if you took a new long position, you would be paying very close attention to that support level. Now, here's what I think we could see for next week. I'll erase this line as well. I think we could pull back just a little bit Monday and Tuesday. And then ultimately, I think we're going to wind up right back at our target that I had from the previous chart. Why do I think that? Because the CCI, which is a very sensitive indicator, is starting to hinge lower. But the stochastics is still showing momentum higher. So we have more or less a mixed signal there, which I believe would create some indecision on Monday and maybe less follow through than what we might have expected had that been a green candle. Now, the end of that line also brings us to a point that would lead us over the 20-period moving average. And I think we will next week, especially break out over that 20-period moving average. So that's my forecast for the Russell 2000. If we look at the Dow Jones Industrial Average, you'll see here, again, I left my lines in place. We broke down below that support level, but we gapped down below it. And if you're a follower of our gap trading strategies, you'll know that 80% of the time, gaps will fill. Now, the second part of that equation is that, and I'll erase this right here, the second part of the equation is that once a gap fills, there's an 80% chance that we could pull back. So I do think that we could pull back just a little bit, just what I expected in the Russell 2000. I think we'll see that in the diamonds. And then I think we'll start to rally up, ultimately leading us to the target back here. So I'll erase this. I'll leave the new target in place with this price action forecasted just like that. And if you look at the bottom of the chart, let me zoom in just one more notch. You'll see that last week, not only did I forecast the price, but I forecasted what we would see in the CCI. And I said the CCI would most likely move up. It's done that perfectly. And right here on the 8th of August, we crossed the minus 100 line, which created a buy signal. Now, for the diamonds, we still see the CCI showing upward momentum. And I see here that we had a buy signal on the stochastics with upward momentum. But with that said, while the oscillating indicators are showing upward momentum, I still think we could pull back because the Russell 2000 is a more broad-based index, whereas the diamonds is only an index that represents 30 stocks. These are the industrial stocks. So that's my forecast for the diamonds. Now, I'm going to hop right to the VIX. If you're a regular follower of the market, guys, you'll know I talk about this every week. The VIX, the volatility index, is inversely related to the S&P. So whatever I say, I'm expecting to see on the VIX, expect the opposite on the S&P. That's why I'm starting off with the VIX. I said that we would move up to test resistance. We did that. And not only did we test it, we blew past it and then pulled back. And then I said we would most likely pull back on the VIX. The CCI is starting to hinge right there. But I do believe the VIX is going to eventually hit this price target. Why? Because that price target is a former resistance area back here. Once broken, turns into support. So I'll erase this, but I'll carry it over to the right. This new support level will most likely see the VIX pull back to it and then possibly bounce. So that's my forecast for the VIX. Now, again, what does that mean? If we're expecting the VIX to go lower and then rally, we're expecting the S&P to go higher and then ultimately pull back. Again, the opposite of what we're seeing in the VIX. So let's take a look at the spiders. It's ticker symbol SPY. It's the ETF for the S&P 500 ETF. I think that we will see the S&P move higher, just like this. And then I think we're going to start to pull back, just like that. So I'll erase this line to keep the chart nice and clean. I will erase this line again to keep the lines nice and clean. And I'm going to establish this as the new flatline support level just above the 280 mark for the S&P. So that's my forecast right there. Again, notice the CCI. I forecasted that last week that we would most likely rally. We did just that. Look at that. It almost followed my line. It's not a coincidence. That's just how we read the technical signals, and they are very reliable. Now, if we look at the Qs, ticker symbol QQQ, this more or less represents the NASDAQ market or the tech sector. Again, focusing on that CCI, I said we would most likely go up. You see that right there? That's my forecast line. We did that. We created a buy signal when it crossed over the minus 100 mark, which is that horizontal green line right there. So we did create a buy signal on the 7th. And I think that that will continue higher. The tech sector is a little bit more volatile than what we have seen in the Russell 2000. But you have stocks like Netflix, which has news out on it. You have Amazon. You have Apple. These are stocks that are going to contribute to the volatility. So I think that the Qs will move up to test the 20-period moving average, which will be right here. And then I think the Qs could actually start to pull back. So we have a difference of forecasting in the different markets. But the tech sector a lot of times will move against the Russell 2000 and even against or opposite the diamonds. But overall, I think that you can see the signals are clear because, again, I'm following the momentum indicators. Yesterday, we had a buy signal. When this blue %K on the stochastics crosses over the red %D, that generates a buy signal. And a lot of people follow that. So we are more or less promoting the most popular indicators because if the masses are following that as a buy signal, then guess what we're expecting? The masses to buy on the buy signal. So that's how we're looking at that. And again, whatever I'm saying here, we could absolutely see the opposite, but keep in mind that we promote the 1% rule for managing risk. I did a webinar for the Scotia iTrade clients, and we talked about the 10 biggest mistakes for traders. And one of the things is that people tend to marry their stocks. That's the number one rule. Don't marry your stocks. Protect them. Protect them with stops or options, or at least look at the charts, because when the signals start moving against you, there is no reason for you to hold on and hope that things are going to get better. It's much more profitable for you to take a small loss and preserve your capital than to hold on to a loser that's sucking the capital or the cash out of your buying power. You don't want to do that. So follow the charts, protect your positions, use the 1% rule, and then you'll be absolutely fine. If you want to learn more about what we do at the market, guys, go to the Market Guys webpage, this is themarketguys.com, click on the video tab right there, and if you scroll down, you'll see second row to the left, cup and handle pattern. You'll see trading the gap right here, and just to the left of the trading the gap video, you'll see the 1% rule. This is where we focus on risk management using a very simple mathematical formula that I think you'll be very happy to see. If you're not using it already, it's something you definitely want to pay attention to, because I've always found that the most successful traders are the ones who manage risk the best. It's not how much money you make when you're right, it's how little you lose when you're wrong that matters. So have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.